This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
I'm at Jason Hartman's event, and I found that this event is really helpful because I'm totally a newbie to real estate investment. And so far I found it extremely helpful in looking at this as a sort of less risky way of investing in real estate. And it's been really an amazing event for me because all the content has been extremely helpful with what I want to get into.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Greetings, empowered investors from Dallas, Texas. Today, we have a returning guest, and that is Mike Simonsen from Altos Research. We've got some really important data to cover as inventory is increasing. And is that a signal for a market shift? So far, all the crash grows have been very, very wrong. And the market has continued to increase in price. And it is still increasing in price. But inventory is inching up a little bit. So does that mean a change? Does that mean a change? We're going to explore that with Mike Simonsen. Now, I have a speaking engagement and a mastermind group meeting here this week. And we just finished our Empowered Investor Cruise last week. I tell you, don't miss one of our live events, folks. Never miss our live events. Mark my words on that. Everybody just loved it. We learned so much. We had so many great speakers on the Empowered Investor Cruise. But we've got another great thing coming up for you on Wednesday. Remember, the second Wednesday of every month, we have our free Zoom meeting. And this month, we are going to talk about something almost everybody can benefit from in a big, big way, and that is cost segregation. Now, this world of cost segregation has changed dramatically over the years because it used to be something for only big investors with big commercial properties. I remember the first cost segregation study I did was on an apartment complex I owned. It was 125 units, and I paid $22,000 for this cost seg study. Nowadays, though, you can do them on your single-family homes. And I just did them on 3 of my single-family properties, and it is amazing the savings. You do not have to be a real estate professional to benefit from this. You do not have to have below $150,000 in adjusted gross income to benefit from this. Everybody can benefit from it, almost everybody. So join us on Wednesday. Go to jasonhartman.com/Wednesday. This is a free Zoom meeting. It is not a webinar, it's a Zoom meeting. So everybody can participate. You can get your questions answered. We have an expert on with us. We'll have a fantastic cost segregation expert on with us on Wednesday. You just don't want to miss that. jasonhartman.com/Wednesday to join us for the free Zoom meeting. It is my pleasure to welcome a returning guest back to the show, and that is my friend Mike Simonsen with Altos Research. He is the founder, and he's a great data guy, really does a great job at expressing the reality of the marketplace. And I think you can be a little bit surprised at some of the things he has to share today. Mike, welcome back. How are you?
Thanks, Jason. Great to be here.
Good to be here as well. And I think it's been over a year. I can't believe how fast time flies. I could be wrong about that, but it's been too long anyway, Mike. So we're glad to see you again. What is happening in the real estate market? There's been a lot of turmoil since you were last on with the National Association of Realtors and these commission lawsuits and settlements and so forth. But just give us your take.
So this year, it's now second quarter. It's the rolling into the peak buying and selling season. The biggest trends of the year are that we are finally seeing a little more inventory nationally than we saw last year. So we're seeing inventory grow. We're seeing new sellers each week grow, about 5, 10, 15% more sellers each week than the same week a year ago. So that growth, and really what that growth means is that it allows for more sales to happen. And so in 2023, we had dramatically few sellers. That tight inventory meant that any demand was gobbling up that supply. It actually pushed home prices higher in 2023. But there was a lid on home sales that could happen because there simply weren't enough homes for sale. As mortgage rates stay higher for longer, that allows more inventory to build. It allows we can see more sellers inching back into the market, and therefore we can see more sales starting to happen. If mortgage rates jump, buyers stop really quickly. And so any growth in sales we are having right now are fragile. Like if rates jump from here, then our growth in sales rate is a little bit fragile. But if they stay flat about 7 or drift lower, that will allow for home sales to grow this year. So there are about 7% more homes in contract right now than a year ago, and that could go higher from here, especially if rates start to ease down into the mid or lower sixes.
Okay, so sales volume has picked up a little bit. So the realtors are a lot happier with that. The title insurance people, the escrow companies, the settlement providers, the home warranty people, the lenders certainly are happy with that because there's more sales volume. And folks, that contrary to what all the crash bros out there say, look, I mean, I guess you could express it this way, right? I've always said there are 3 types of markets. Most people think there are just 2. There's a buyer's market and a seller's market, but I think there's a third one, and it's called a broker's market. Okay. And to have a broker's market, you need inventory. And, this really occurred to me, Mike, about 20 years ago when one of my agents sent me this email. Her name is Marty. She's still working at my old company that I sold to Coldwell Banker. And I remember her sending me this email when inventory was very, very low. And she said, gosh, I just so wish interest rates would go up because then I'd have more inventory and I'd have more houses to sell. There's just nothing for sale. And, this was in Southern California, in Orange County, California, where I'm from. And, I just completely agree. That's the thing. And so, we've got 512,000 homes for sale in the US, I believe was your last report. That's higher than the COVID era lows of about 240,000, but it's a far cry from normal, which we need to add about 700,000 more homes to be normal. Right?
Yeah.
So,
and we can see a few things, Jason. We can see there are some parts of the country which are back to more normal times, like pre-pandemic times. Some of the really it's around the Gulf states. So like Western Florida, around through Louisiana and down into Texas, those markets have grown inventory more. And those tend to be like higher property tax markets, high insurance costs.
Texas has high property taxes. Yeah, that's for sure.
Yeah. And especially compared to California, where our property taxes never go up. And so as a result, it's you hold real estate longer in California. And so we can see that turnover happening and driving inventory higher, especially those Gulf states. And then there's places like Boston and even San Francisco right now have very low inventory, barely coming off the pandemic lows. Inventory is growing pretty much everywhere across the country, like growing over last year, pretty much everywhere across the country.
A couple comments before you go on. Number one, I have long said, and I don't know if you agree with this or not, Mike, but if it wasn't for Howard Jarvis back in 1978 or something around there with Prop 13, California's property taxes, I mean, look, the prices are high. So the overall tax bill is very high, but the percentage is actually quite low as long as you're not in any of these special assessment areas where there's Mello-Roos or whatever, they got a million different names for these bonds. And, I think that has been one thing that has kind of allowed the California market to appreciate so well over the years is the fact that you have these very low property taxes and older people could afford to keep their houses, which artificially kept inventory low. Whereas it in a place without Proposition 13, like they have in California, would have caused people to sell as their taxes got reassessed every couple of years.
That's exactly right. And that was the whole point of a Prop 13 in California is like, don't let granny get kicked out of her house.
Right. Yeah.
And it works. The downside is that we give the advantage to granny over our kids.
Yeah.
So there's chronic shortage of inventory in California, and it pushes home prices higher. It's like doing rent control for the whole state, for the homeowners in the state. But we can see like Texas has high property taxes and adjusts very quickly. So if you bought a house, if your house in Austin appreciated a ton over the last 5 years, then your property taxes went up a ton too.
Yep.
And so you're much more likely to resell that than to hold on to it. And that turns out to make a healthier market for buying and selling a home in Texas. Keeps it more affordable, keeps more selection available.
Yeah. Yeah. It
And what it means
keeps
right
more
now,
churn,
yeah,
right? Where you
more
don't
churn.
have this. And like you said, it's like rent control for the state, because in rent controlled markets like where you are in San Francisco, people just don't move.
You don't
And you
move.
get this really stagnant, weird market. It becomes very dysfunctional. You have these, same with New York City, it's a
Yeah.
very
And
weird
that's what
same
happens to
market.
California in the resale market, right? And so you can see that it's why Texas has a much healthier, more affordable. It's one of the reasons that Texas has a healthier, more affordable. And it's ironic because it's like due to high taxes, but
Yeah.
that's how it works, right? But what it means though is right now, many of the Texas markets are now back at their pre-pandemic normal levels of inventory. It means that you can see therefore less upward price appreciation, which in an affordability, like we have an affordability challenge right now. And so that means that that market becomes more accessible again to more buyers. So those are underway right now in especially those Gulf states, but inventory is growing everywhere across the country right now.
Right. Yeah. So it's growing a little bit. So, I say that's a good thing. We need it to grow a little more to get into more of a healthy market with some dynamism. It's been very closed down for so many years. Do you want to share some of your great visual aids with us?
Sure. We can dive in. We're looking at this week's data. So at Altos, we track every home for sale in the country every week, all the pricing, all the supply and demand, all the changes in that data, and then we publish out the data. So this is data including all last week, published. This was through April 5th, and it actually includes the Easter weekend in there. So right now there's 513,000 single-family homes on the market around the country. So it's 25%. It's 100,000 homes more for sale right now than a year ago. And in this chart, each line is a year. And so the dark line there, 2024, you can see it keeps expanding versus last year. And mortgage rates are higher. That means more homes are like demand slows, inventory grows is a way to think about that. So, as mortgage rates stay in the sevens, we see inventory growing. You can see though that there's for fears about whether there's too much inventory, like do we have a price crash coming? We can see, and I think you pointed this out early on, the gray and green lines up there, those are previous years. So there might be 800, 900,000, a million homes on the market in the second quarter not too long ago. And right now there's 513,000. So we don't really have they don't see anywhere in the data like a flood of inventory, but as you point out, like more inventory, more supply is a good thing. More supply is very clearly leading to more sales. So more sellers means more sales happen. And so like all of those things are good in general for the housing market. So
and for the broader economy. I mean, look, when someone buys a house, they go and buy furniture. They go and buy appliances. They spend money at Home Depot and Lowe's. It is just a very stimulative thing. And this is why, folks, the politicians will do anything in their power to keep the real estate market going, okay? Because it's such a huge part of the economy. It just has such a ripple effect on so many different industries. So it's a very important part of the economy.
yeah, and we can see that in essentially all the laws, are designed to help the homeowner. They're designed to make sure that you get your tax breaks, you get like all the policy we do is about helping the homeowner. And so as a result, over time, we own more homes and over the years, and you can see really 18, 19, and you can see how year over year, fewer and fewer homes have been for sale over the last decade. And we're now coming out of that with higher mortgage rates for 2 years. We're 2 years into rising rates now.
Yeah. And isn't it amazing, Mike, that, I mean, if you consider the highest rates went and the lowest rates out there that people still have, right? The cost of money on this credit-based asset, real estate, has virtually tripled, right? And there was no crash. Prices kept going up in the face of the cost of money tripling. Like, think of what other asset could withstand that? That is a barrage. I mean, that's amazing that it has been this resilient. It really amazes me.
It amazes me too, and if we look at this point, we take April of last year, April 2023. At that moment, we were showing year-over-year home price declines. The fourth quarter of 22, rates had jumped all year long and jumped even more in the fourth quarter, and it really slowed the market down. And so by April of 23, we were showing home price declines versus the previous year. But what happened last year, which surprised me, because there was so little new supply, that the existing demand was there to essentially keep a floor on prices. So even though demand fell, supply fell dramatically, and that really kept a floor on prices. And we ended the year with about 5% home price appreciation last year, in a year when demand was way down. And it was really hard to bet on that a year ago, right? It would have been really hard to bet on that a year ago. So that was a bit of a surprise, that people, like, how all those pieces ended up working together.
Yeah, well, that's the lock-in effect for you. It's just keeping people from selling. It's kind of like we have tens of millions of people in America with Prop 13 rent control.
Yes.
They don't want to give that up.
That's exactly what we have.
Yeah.
And it is a generational benefit, in that, the people will have that, like, I have a 2.8% mortgage and I'm not selling that house. And now, on the other hand, there are 5 million people a year who do buy houses.
Yep.
So now we have 10 million people who are not locked in.
Mm-hmm.
And that's one of the reasons that we will see more and more relisting inventory each year, that we have higher rates.
Absolutely. Yeah. Yeah. So even in a low volume market where you're going to have maybe, just under 4 million sales versus 5 or 6 million, which you'd want to have to be in a normal dynamic market. In that market, though, you do that for a couple of years and people start to peel off, and then you reduce the lock-in effect, which is a great thing, because I'd like to see some more sales and some more inventory.
That's exactly right. And so we're 2 years into higher rates. And so we look at this chart here, inventory, so these are single family homes on the market. And people ask me, when do we get back to the old normal levels? Mm-hmm. And the answer is, like your agent who worked for you 20 years ago, the answer is when we have higher rates for longer. We have multiple years of higher rates. Each year, we're going to see inventory build, and we'll build back closer to the old normal levels. And so it took us a decade to get down to the pandemic crisis lows. It takes us a few years to get back to the old normals. And so you can see the red lines there. Last year and the year before, you can see inventory starting to build as rates climb. So rates rise and inventory rises.
But again, overall, it's a drop in the bucket. So
yeah, it's slow. And on the other hand, we have a lot of forecasters, I don't forecast mortgage rates, but there are mortgage rate forecasters who keep assuming that rates are going to fall this year.
Yeah.
And if they do fall, what's going to happen is we'll stimulate demand more than supply. So our inventory levels will start to fall again. So if rates are about 7 right now, 7% for a 30-year fixed mortgage, if they fall to 6 or into the 6.5 or, closer to 6, like, you'll see this trend reverse and they'll start to compress again.
I completely agree. Mike, this is a little bit of research we did. We have an economist that works for us, and I gave him this assignment of researching how many more people could qualify at different mortgage rates. And so what we did is I said, just use a baseline of 7% mortgage, right? Could be higher or lower, but we got to start somewhere, right? So if 7% is our baseline, right? Our sort of benchmark rate. And we fall down by 0.5 point in mortgage rate reductions. Now, keep in mind, at the beginning of the year, Fannie Mae predicted by the end of this year, we would see 5.6% mortgage rates. It doesn't look like that's going to happen, folks. I think they're going to revise that forecast. Maybe they already have, and I haven't seen it, but Uncle Jerome Powell is being pretty tight with the purse strings on the rates. That's for sure. But, the pivot is going to occur. I think we all know that's coming. It's just when is the question. So if rates drop 0.5 point, that means that 2.8 million more people can afford the median price home. Now, of course, they won't all enter the market, right? But say a third of them enter the market and they start bidding and they start putting offers on houses, and then there are multiple offers on houses. And so, if you have 700,000-800,000 people come into the market, in a market where you only have an inventory of just over 500,000 homes, Folks, this is just supply and demand. It's not complicated. Now, if rates go down to 6%, that means 5.4 million new people can qualify. If they go way down to the what's called the magic number by John Burns, right? And I think you've talked about that, by the way, Mike. I don't know if he started with that, but that's the first one I saw, mention the magic number. Barbara Corcoran's using that term now. That's 7.7 million new buyers. I mean, what do you make of this? This is crazy in a market where we have 500,000 homes, or maybe by then we'll have 600,000. So what? It's nothing compared to the demand. And, I'm only just assuming maybe a third of these people actually enter the market. Your thoughts?
Yeah. So, I think this highlights the message that I have been trying to communicate recently, which is that it's actually, I don't see it as a magic number. I don't see it as a fixed number like 5.5%. For a while, I was looking at that. We were coming out of the 2023, 22. We were watching, we could see where people would start to buy. We'd see where it would slow down. But what I've observed recently, and we can see it really clearly in the data, is that consumers are more sensitive to changes in rates than to the absolute levels.
Yeah, that's a good point. Expand on
that. So if I'm shopping at 7%, and suddenly it's 6.5%, it looks like a bargain.
Yeah.
If I'm shopping at 7% and suddenly rates are at 7.5%, now I take a step back. I don't make an offer. We can see that then those sellers don't get their offers. Then inventory builds. Then they do price reductions. Like we can see it across the board, pretty much to the day of the big mortgage rate spikes. And so, I think about like we've been traveling now in 7%. We started the year in January, was in the 6s, but then rates pretty much climbed all year. They maybe a little higher early March, back down a little bit, but we're still in the 7s. So rates have essentially been climbing all year. And we can see that, like I mentioned, we're trying to sell. There's a little bit more sales happening, but you can also see how that is held back by rates having not receded. So now, though, they are flat at 7, and we can see the sales starting to build again. And if they drop from here, then we'll see a big spike. But if they spike from here, then we'll see that slow down again. And so we can see it really directly correlated. So right now, because rates have been at 7, the magic number is 7. So they fall below 7, like that stimulates demand.
In other words, it's all relative, because the way the human mind works is by answering the question I ask all the time, compared to what, right? That's the way the only way any of us know the value of anything, money, goods, a potential mate or a date, is by comparing it to something else, right? That's the only thing we do, is we're comparison beings. And that's why you saw all these people that have been around a while. As soon as the rates spiked, they said, well, when I bought a house, rates were 18%, in the early 80s, right? Or whatever, right? But of course, houses were a lot cheaper. You didn't bother to mention that.
Yeah.
But it's just all relative. Sure.
It is relative. And what really the lesson here is how quickly we reset our comparison. So, rates have been at 7 for a few months. We're comparing to 7, and it's only a few months, right? We're not comparing to 5.5. We're not comparing to 3 from 2 years ago. We're comparing to 7. And so if home buyers have been shopping this spring and they're looking around, they're setting their expectations about what kind of home they can buy based on 7% mortgage rates.
Yep.
And so it's only a few months of stability that then they go, okay, but if rates jump to 7.5, now they're frustrated.
Yeah. And we'll be back with a lot more on this topic with this guest on our next episode.
The following is a blog post found on jasonhartman.com/blog.
The possibility of buying rehab properties in the area of real estate investment is highly ideal and attractive. Whether you were able or not, you can make an asset out of a distressed property. You are always going to be very tempted by this perspective. Still, the depth problems might be a part of the story. However, this is unfortunately the reality of the situation, and the buyers usually encounter it when trying to find the best rehab project. From both a financial and logistical point of view, facing these barriers means making a lot of choices. In this article, we go into depth exploring the top issues associated with buyers searching for rehab properties and provide the remedies towards them. 1. Financial constraints. Limited budget. One of the most prevalent problems of customers is acquiring enough capital to fund their rehab projects. Having limited financial resources may either lead to property selection restrictions or sacrifices in terms of quality. Financing options. Suitable financing options to buy may become the biggest problem for those who have bad or no credit history at all. Conventional financial institutions can be unwilling to give loans for rehab properties as they are considered to be risky. 2. Property identification. Finding suitable properties. Finding the right rehab property in a desirable location is a task which can be easier said than done. Competition among buyers and limited inventory can make it sometimes difficult to satisfy your criteria of right price, potential, and location. Assessing property condition. Figuring out a correct status of a rehab property is of great importance for setting accurate repairs budgets and profit expectations. On the other hand, it can be hard because houses may have underlying problems that are not visible at first. 3. Regulatory and permit challenges. Navigating regulations. The rehabbing of a given property shall normally follow a very tortuous route through a most intricate maze of regulations and zoning laws. As a result, the intersection between regulation and business is complex, and companies should avoid penalties and costs that result from compliance violations. Obtaining permits. Obtaining the right permits for remodeling can be a bureaucratic hassle for buyers. Permit delays may destabilize project scheduling and raise costs. 4. Construction and renovation risks. Cost overruns. Renovation projects are known for going beyond unplanned costs caused by unforeseen complications or changes in the scope. The buyers are always trying to manage costs and to mitigate the risk of overruns. Contractor reliability. It could be quite challenging to find a contractor who does quality work on time and consistently. Poor assembling or project delays can delay rehab projects and cause potential profit losses. 5. Market volatility and uncertainty. Fluctuating market conditions. The real estate market is by nature cyclic, with changes in demand, supply, and property value appearing now and then. The investors face market instability and adjust to probable changes that can influence their investments. Economic uncertainty. Factors like interest rates, economic indicators, and geopolitical events often make the real estate market volatile. Consumers need to keep up to date and modify their approach as necessary. 6. Exit strategy challenges. Selling at the right price. At the end of the day, the key to a rehab project is to sell the renovated house at a profit. Producing the most accurate selling price will result from an in-depth market analysis and correct timing. Market saturation. In competitive markets, an overhang of rehab properties results in sustained holding times and reduced selling prices. Homebuyers must build brand and implement the best marketing tactics in order to sell their properties fast. Conclusion. On one hand, the search for and the rescue of ill-fated properties can appear to be a tough decision, but on the other hand, it presents splendid opportunities for prudent investors. Through identifying and solving the primary issues that buyers are confronting while searching for rehab properties, investors can unlock an enormous potential to grab the gold in this very dynamic market. By relying on methodical planning, in-depth research, and persistence, it is possible to identify the potential of rehab projects and realize the objectives that were set out when the investment was made.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.